Hello, everybody. Welcome back to the Enlightened Investor. And we have over here my good friend, Mike Mahoney.
Good to be back.
Those business trips keeping you busy, huh?
I have been working remote for a while now. I find it's much better to work where it's warm than where it's cold in the winter.
Well, speaking about weather, they got the beautiful Masters going on down in Georgia, right? Tiger.
Hanging in there.
I'm looking for. I love that guy.
Yeah, be good. And I love that tournament. Just great history.
Great history.
Great course.
Well, folks, speak about great history.
Too tough for you golfers like you and I.
Oh, gosh.
Yeah.
The only person that could play it is our producer, probably.
Right, exactly.
Well, anyways, enough about Ryan.
I'm excited about today, though. The Matrix. I've been waiting for this series, folks, for a long time. Joshua's been waiting. He's been working on this. We're going to discuss the Matrix today.
Instead of handing you this big, fat book, we're going to actually go over some incredible statistics that most people get a little bit bored about, but we're going to have some fun with it and look at some quotes from the movie, the trilogy, The Matrix, and relate that to investing. But we've got some really cool stuff for you today. Let me just kind of briefly go over what today's show is going to be about. We're going to talk about the issues of Americans making decisions based on the short run only. That's been a big problem for them. Number two, we're going to look at how short run market returns are just noise. Number three, we're going to take a look at in the long run. You are out in this beautiful area called the Green Pasture, and just hang in there. The Green Pastures are a great. It's a land flowing. Good visual. Land flowing of milk and honey. And the last one is why do small value caps outperform basic overall market indices in the long run? So that's a pretty cool day today. So folks, get ready. We're going to start off today with a home run, looking at the Matrix videos, and so. And we're going to look at the architect first. And the architect, if you know, he's the in the Matrix video, he kind of created the Matrix. And here's what he has to say. Here we go.
Hope. It is the quintessential human delusion, simultaneously the source of your greatest strength and your greatest weakness.
If I were you, I would hope that we don't meet again.
We won't.
Hope. It is the quintessential human delusion, simultaneous the source of our greatest strength and our greatest weakness. Can you tell us a little bit about hopium and investors, Mike?
Well, I mean, hope. I think beyond investors to life, I think hope's a great thing. Well, without hope, we're all lost, right?
Correct.
But hopefully, I mean, the problem is a lot of people I don't think have a plan, and they just hope that things work out, and that's a tough plan.
So tell us about maybe the crazy statistic that we just came about yesterday about the lottery.
Well, yeah, you just showed that to me. So 39% of the people think that that's their effective strategy to retire. And, I've never seen that number before, but I guess, I've seen a lot of numbers with a lot of people that are woefully saved for their retirement. So it makes sense to me.
So yes, hope is a good thing. And it also is one of our greatest Achilles heel. Number two video is from the great and powerful Morpheus, right? Let's take a look at what he has to say on the next video.
This is your last chance. After this, there is no turning back.
You take the blue pill. The story ends. You wake up in your bed and believe whatever you want to believe. You take the red pill. You stay in Wonderland. And I show you how deep the rabbit hole goes. Remember, all I'm offering is the truth, nothing more.
Okay, thank you, Morpheus, for that powerful quote on remember, all I'm offering is the truth, nothing more. And so the truth, what is truth? You go take a class over at Bradley University from our religious studies department, and many people say there is no absolute truth. But when it comes to investing, we have an absolute truth that people will not even, it'll be hard for them to even understand. That is, if you look at this Matrix fund, this book, we find that any investor who has bought and held their equity portfolio, a total stock market index portfolio, from 1926, get this, all the way to 2020, every single buy and hold investor has had a positive rate of return. Incredible.
Well, and also, I mean, if you just extend it out, I think we looked at the diagonal on that, and we'll show that later on. I mean, if you put it to a 15-year period, everybody had a positive return most of the time as well. So
Yep. And that's even
very rare instance.
Very rare. So let's talk about decisions that should be made with the future mind. Thanks for the Matrix trilogies for those great.
Can I explain the Matrix book a little bit?
Yeah,
too?
go ahead, please.
I'd like to explain it a little bit. So the Matrix book is a data book put out by a strategic partner of mine, Dimensional Fund Advisors. And what they do in this book, and we're going to put out a PDF version on our website, and it's kind of cumbersome to look at on the internet, but you'll get to take a look at it. And they use different indices. They provided a graph and a chart that shows the returns by year. It shows the annualized returns for every period, all the way from 27 through 2021. Different asset classes. They'll even show, the fixed income asset classes. They even show them net of inflation to show real returns. And then they show some model portfolios that are diversified in the back and compare that to like a market index. So it's a really good tool for taking a look at the historical data of capital market returns from almost close to 100 years now.
Yep.
And it's updated every year, so it's pretty cool. So you'll
It's
see
really
a little
cool,
bit.
very insightful.
And today we're going to take that and go to the greener pastures.
Go to the greener pastures.
Jeff Troutner.
Flowing with milk and honey.
Yeah,
Okay.
okay.
So thanks for that background
sorry,
on
I
the
wanted to give a
Matrix.
little explanation.
Sure. And I hope we can do
That's
this.
because that's what it's all about, the Matrix, right? We're talking about the Matrix here. I had to explain what the Matrix book is about. Thank you. Back
Thanks,
to you,
Mike.
Joshua.
You always keep us on
Back to you.
task.
Back
I
to-
appreciate
back to
that.
you. Yeah.
So let's talk about like short run decision making and what bedevils the American saver household investor. Like, why do so few investors, weight the future kind of equally to the present? Like they always discount that future.
It's a lot simpler to live in the present and not worry about the future, I guess, right? And it takes work to plan. I don't know. I mean, it's probably all of the above.
Yeah, all the above. And, Americans are impatient and deeply discount the future. 80%. They have what's called like a hyperbolic discounting, where there's massive discounting going on like right away in the first couple of years out, and then it kind of levels off. There's a little graph here on that next one. And even this article from Schweber and Weber on the time inconsistent preferences and the annuity decision on this annuity puzzle, find that like people don't use economic reasoning when they take a lump sum versus taking out a yearly annuity or a monthly annuity. They always choose the cash right away.
Well, yeah, but to be honest, though, I mean, sometimes I may tell them to do that as well. It just depends on the math of it. But yeah,
Right.
I understand where you're coming from. This is a behavioral thing. Yeah, give me the
Yep, that's right.
Give me the money.
Give you the money, and even though you might have a better annuitized,
Well, and I'll mention this too. I mean, and it's not even people delay planning, not just for investing, but even when it comes to estate planning, people put things off. It's just we don't want to do that. It takes work, and sometimes it takes a little pain, right? So it's better to just feel comfortable.
comfortably
Yeah,
numb.
so-
Isn't there?
yeah,
Isn't there
right,
a,
I guess.
a
I don't
song
know.
like
yeah,
that?
so I guess we're coming
Comfortably numb?
back to the economy talk. No, the economist talk. I
Oh,
should say.
yes,
I'm
economist.
looking forward to this one.
Well, so even economists are prone to making these short-run decision making. Just a quick story. We were at a conference not too long ago, and the conference was at a hotel, and we had a lunch that we could go to, and you were supposed to make your dinner selection like a month or two in advance. And they gave you two options, like a healthy option and an unhealthy one. So salmon and like a salad versus a hamburger and French fries and a shake. And what ended up happening was everyone picked the healthy, the selection a month or two out. But what ended up happening.
Burgers sure look better sitting across from you, though.
Then what happened was they forgot our orders, and everyone had to reorder the day of the event, and then everyone ordered burgers.
Sure.
Yeah, why not? So, burgers and shakes. So anyway, we have this problem too. Let's talk about the short run. Market returns are just noise. This is some interesting graphs here. And Mike, I'm going to have you take a look at this one, like how yearly returns are just random.
Correct.
I mean, different asset classes have great returns, and then the next year they have terrible returns.
Well, and you can get periods, as you know, I think we discussed this prior. I mean, you can even get 10-year returns that are random, right? I mean, there's 3 times in history where the market return for equities equaled the 30-day treasury. Think of a 30-day CD, 10 plus years. So you can get randomness that can occur for a very long period of time. Now, that's unusual, but I mean, when you get down to a yearly basis, it's totally noise.
It's totally noise. Exactly.
But we like certainty.
We like certainty.
So the industry will love to tell you all about all the reasons why every year does what it does or what they think it's going to do, and half the time it probably doesn't turn out that way.
Yep, exactly. Because no one knows the future, Mike.
Correct.
And so this gets us to our first green pasture,
Right.
matrix shot. And it might be kind of hard for you to see this triangle. And really what this is, as Mike was saying when he introduced it, it's looking at annualized returns. And then overall, if you start like maybe on the left-hand bottom
red.
in the red, that was back in 1926. That was that little point right there shows that there was a negative rate of return. But the longer you hold your allocation to the total stock market index, you end up getting these green pastures. So starting from west left, I guess that'd be the bottom left. If you make that's the 1926, and if you move your eye up to the right top, that's 2021. So you can see that someone who started investing in 1926, way back on the bottom left, they have many years to stay invested. And by the time they get to 94 years later, they're in the green pasture. And you can see here that if you go through time, as you move your way from right to left, from left to right, upward, that these particular years, you can see that there's some randomness or choppiness in the rates of return. But if you just hold on,
right, you get out to those 10 and 15-year bands, and it's pretty much green all the time.
It's green all the time. And that's the truth. That's the Morpheus truth we want to share with you today. And you can see this also in a graphical table form, like volatility declines over the years, over time. So like, for example, if you look at this matrix document, it shows us that the worst year was 1931. You were down 43.5%. But the best year, where you were up in 1933, 56%. But if you go back to like a 10-year horizon, there's two periods, I think, within the U.S. that we had what they call lost decades. And I've experienced one of those lost decades from 2000 to 2009. But the worst 10 years was 29 to 38. But the best 10 years was 49 to 58. But and really, I want to take a look at that first 20 years. Folks, and this is kind of relate to my story. If you take a look at the years 1979 to 1999, that was the best 20-year period where returns averaged 17.6%. Every year compounded.
Well, we've done close to that the last 20 as well. Again, we're doing, it's not the .com. I don't want to say, for lack of a better word, bubble, but we have the tech quote growth thing going on now as well. So, but the other thing I want to mention is we're talking about volatility of the whole market, but which we're not getting into today. But most people don't have a portfolio that's 100% equities, and hopefully, if you do have if you're young or you have maybe a trust that's for young people that's put aside, maybe you are 100% equities, but it's going to be diversified equities, not just the market. So we're just talking about the U.S. market as a whole today.
Yep, just the market as a whole.
But
we'll
get
folks.
into some of the diversification.
Exactly. Yeah. So investing in the total market index funds or ETFs is a way to participate in the overall growth of the U.S. economy without the higher risks, higher cost, and greater uncertainty associated with stock market timing and picking. And, 8 of the 10 years are up in the overall U.S. economy, so 8 of the 10 years are up usually in the stock market, right?
Correct. Which is why you don't want that's the whole thing of this market timing. The big talk right now, and we'll do a video on this soon, is impending recession, which is already causing some people to get out.
Scared.
And
we know some people they're getting out.
The facts, we talked about that. So the whole market timing thing and stock picking doesn't work.
All right. Long run investing gets you to the green pastures. One of the things that I thought was absolutely incredible is if you started investing in 1926 and you just let the market do its thing, and you'd get a 10.33% rate of return on average annually. If you put that in that little calculator right now, we're doing this before the show, you put it in your calculator, you put 1.1033 to the 94th power, you get a multiplier of 10,308. So what that means is $1 invested in 1926 is now worth $10,308. So this is a powerful motivator. Like I even tell this to my kids. I said, hey, if you can start investing now when you're 17, 18, in 50 years, you're going to have 100x.
Yeah, I think the whole message behind all this is the fact that there are capital market returns to be had for the patient. And as we get into it later here, we're going to show that the industry prefers to tell you that you can market time, be tactical, and be a stock picker to win. And the odds for that are very low. And if you just follow the capital markets and diversify, you're going to be fine.
Going to be fine. And the data points it out. The last thing we want to talk about,
the truth, right?
Yeah, back
to
to
truth.
Yeah, that's right.
Truth.
The truth, the Morpheus,
data.
Yeah. And the data is life. So hang in here. This last we're going to talk about very important point. If you've hung on the show this far, this next point is going to blow your mind. Mike, a picture is worth 1,000 words about the investing in U.S. small value versus the total stock market. Why is it that the U.S. small cap market, small value cap, performs better over time than the total stock market?
Well, it's a whole risk-reward story. Think about it. Why does a stock outperform a bond? Normally, most of the time, right?
Yep.
It's a risk-reward.
Yep.
And the other thing also, which we didn't show in here, but in the middle of that would be large value stocks. And this is an issue that we could show globally, too. This is not just a U.S. phenomenon. The data is backed up globally as well.
So I guess maybe if you have a longer time horizon, you can take a little more risk. Is that what you're kind of saying? That because you get the little more...
Well, I mean, it's more or less, it's if you have the ability to stomach, it's the whole tracking error issue, right? But I mean, you can get tracking error with a market portfolio, like I discussed. You could be in a market portfolio and go 10 plus years where you don't get a 30-day treasury return. And the same thing holds for if you have a portfolio that's more diversified and balanced and not just pure market. It's going to have periods where it doesn't track the market like we've seen the last 10. But the previous 10, when you mentioned the lost decade, if you had a diversified portfolio like that, instead of getting a minus 2% return for the decade like the S&P, you were up close to 8% annualized for that decade. So
Yep.
the key is understanding your approach and staying disciplined regardless of it. If the market portfolio works for you, that's great. If you don't like international, that's great. But I mean, once you have a diversified portfolio or whatever your portfolio is built on, you need to have the discipline to stick with it because there's going to be so much randomness and uncertainty, right?
Yep.
But then they got to deal with all the noise.
Yep. Like be like a stamp and stick with the plan, Larry Sudrow, right?
Sure.
And so there's if you want to talk a little bit more on like the number of...
Yeah, I think that's just interesting to see that just how it lays out. I mean, if you look at just based off of companies based equally, if you take the market cap out and just put the number of companies out there, there's a lot more small companies, value companies, than there are large companies, especially large growth. But then when you look at it on a market cap, right, if you base them like, Apple, how big they are compared to Cypress, if we were publicly traded, I guess. And they dominate. And I looked up, as of September of last year, if you've looked at the S&P, the top 10 names were almost 30% of the whole S&P 500 index.
Exactly.
And the names change through time, so that really, you have a few companies that drive it, and which is why it looks really good right now. And time will tell how that works. You'll probably get some reversion to the mean.
Reversion to the mean. It's part of history.
If you forget the valuations.
Yep. So, folks, I thanks for all of you that stayed with it today. This is a very powerful, kind of truthful discussion we had about stick-to-itness, right?
Yeah, and I think it would make more sense, even though it's a lot of numbers to kind of scroll at, just to browse, is take a look at the PDF, look at the various asset classes, and just see the numbers. Because it's what's cool is with the way it shows you how to read that data in the front of the Matrix book. You're gonna, when you go down each year, it shows the annual return by year.
Yep.
But then if you want to take the whole column, and you look at that bottom number, that's the annualized return for that time period. So it's a really cool resource just to compare returns for various asset classes, and they even show it into diversified portfolios in the back, and you can kind of compare the two. Data and truth versus noise.
You have data. Mike, thanks for being here again today. It's
good to be back.
Yeah, it's good to be back. And folks, if you like the content, make sure you hit the subscribe and like button. And
if you have a question, fire away.
All right. This is the Light Investor Team signing off. Goodbye.